However, it does not guarantee that the financial statements are 100% accurate or free from all misstatements due to the inherent limitations of an audit. So a reasonable assurance is a high level of assurance. This is where the auditor gathers sufficient audit evidence that enables him to express a positive opinion. But that does not guarantee that the financial statements do not contain any material misstatements. The auditor may have conducted extensive audit procedures. The auditor may have, for example, obtained data from a large sample that gives him confidence that the financial statements portray a true or fair view. So that's the meaning of reasonable assurance. It is a high level assurance. But we also have limited assurance. Limited level of assurance. This is a low level assurance. Low assurance. A limited assurance is a lower level of assurance than reasonable assurance. In a limited assurance engagement, for example, the review of financial statements, the practitioner performs fewer procedures than in a reasonable assurance. Here the procedures are few. The auditor does not examine, does not carry out extensive audit procedures. You understand? That's why the auditor cannot give high level of assurance, because he has not conducted extensive audit procedures. So the objective here is to reduce the risk of material misstatements to a level that is acceptable in the circumstances, but where that risk is greater than for a reasonable assurance engagement. And the conclusion in a limited assurance candidates is typically expressed in a negative form. For example, the auditor may state that based on our review, nothing has come to our attention that causes us to believe that the financial statements are not prepared in all material respects in accordance with an applicable financial reporting framework. So that's the meaning of limited assurance. It is a lower level of assurance. This is concept number 7. We are proceeding to concept number 8, excuse me, which is direct reporting engagement. Direct reporting engagement, also sometimes referred to as direct engagement. Now, direct reporting engagement is an assurance engagement where the practitioner directly measures or evaluates the subject matter against the criteria and expresses a conclusion thereon. In this type of engagement, the responsible party, like the management, does not initially make the subject matter information available to the intended users. Instead, the practitioner gathers the information, applies the criteria, and reports directly on the subject matter. Now, this is what I mean, candidates. In a normal audit, you recall I gave an example. I gave an example there of audit of financial statements, where the shareholders appoint the management to run the affairs on their behalf. The management is required to prepare financial statements. These shareholders appoint auditors to examine these financial statements. Then they give a report to the shareholders as to whether the financial statements have been prepared in accordance with an applicable financial reporting framework. So you see here, the auditor relies on information that is provided by the management, the financial statements. Then expresses an opinion on these financial statements as presented and prepared by the management. But in direct reporting, I'm saying that It is still an assurance engagement, but this practitioner, the auditor, directly measures or evaluates the subject matter. Directly measures or evaluates the subject matter against a criteria and then expresses a conclusion thereon. And in this type of engagement, the responsible party does not initially make the subject matter available. Here, the subject matter is made available by the management. In a direct reporting, the financial statements are not available, but this practitioner gathers the information directly. Now, a good example is an environmental auditor. An environmental auditor might directly measure a company's carbon emissions. Environmental auditor may measure a company's carbon emissions directly, okay, against a specified environmental criteria, then directly reports on the level of emission. Because the information that this subject matter is carbon emissions. This is the subject matter. The management does not provide information on carbon emissions, but the environmental auditor does it directly, as opposed to audit of financial statements where the financial statements are provided. Here, the subject matter, which is the carbon emissions, are not provided. The auditor measures these emissions directly, then expresses an opinion. It could still be an aspect of the financial statements. Another example could be an auditor, a financial auditor may come to the company and evaluate or measure, say, inventories. Go direct to the warehouse and count all the stocks that are within the warehouse, the ones that are on transit, then give a valuation of the inventories directly, may measure directly without referring to or relying on information provided in financial statements. That's the meaning of direct reporting candidates. The practitioner directly reports on the subject matter, not on an assertion made by the management or responsible party. That should be clear, candidates. That is clear. Direct reporting engagement. Direct reporting engagement. That is the 8th concept. The 9th concept is attestation engagement. Attestation engagement. Number 9, engagement. What is an attestation engagement? Attestation comes from the word attest, to attest. To attest is to confirm. It is to verify. Okay? Attestation is a type of an assurance engagement where the practitioner or the attester, the practitioner is the attester, is where the attester evaluates a subject matter against a criteria and provides a conclusion about the reliability of a written assertion that is made by a responsible party or another party who is the asserter, the one who asserts. The practitioner's report provides assurance on the assertion made by the responsible party, not directly on the subject matter. Okay, an example is a financial statements audit, which is an attestation engagement. The management asserts that financial information or statements are presented fairly in accordance with the International Financial Reporting Standards. The auditor then provides an opinion on whether the management's assertion is true. I'll come back to my example. The shareholders appoint the management. The management have a legal mandate to prepare financial statements. These shareholders appoint auditors, the profession, to audit these financial statements, then report to the management. I've given audit of financial statements as an example of an attestation engagement. The financial statements as prepared and presented and management represent what we call management assertions. For example, in the balance sheet, you'll have record of fixed assets, you have records of liabilities, you have record of capital. All those items are recorded. Motor vehicles could be 15 million, inventory 20 million. Those are assertions. It is the management that asserts that the total fixed assets is equal to 100 million Kenya shillings. This is an assertion. The management is the responsible party. It is the asserter. The auditor is the attester. The auditor comes in to give an opinion. The auditor provides assurance on the assertion made. The assertion is fixed assets, for example, is 100 million. That's an assertion. This auditor comes in and evaluates, examines the financial statements. The auditor may even do physical checks, may want to see the physical motor vehicles and evaluate and give his opinion as to whether it is true that the financial statements as asserted by the management portray a true or fair view. So the auditor attests, the auditor confirms, the auditor gives assurance that it is true as reported by management, the company's financial assets are valued at 100 million. So a financial statement audit is an attestation engagement. That's an example where the management asserts that the financial statements are presented fairly, and the auditor then provides an opinion as to whether the management's assertion is true. The auditor attests to the assertion. So the auditor is the one who attests. It is the auditor is the attester. You understand? And an example is an audit of the financial statements. That should be the opposite of direct reporting, where the auditor does not rely on information of the responsible party, but the auditor directly carries out an evaluation on the subject matter, then gives the opinion. That's the meaning of attestation engagement. And that's the 9th concept. We are currently studying basic concepts in auditing. We've defined auditing, we've defined assessment, number 3, monitoring, number 4, assurance engagement, number 5, non-assurance engagement, number 6, reasonable assurance, number 7, limited assurance. We've discussed direct reporting engagement, attestation engagement. We are moving to the 10th one, which is compilation engagements. Number 10, compilation engagements. Compilation is derived from the word compile. Compile. Compilation engagements are non-assurance engagements. This one is an assurance engagement. Attestation engagement is an assurance engagement. The auditor expresses an opinion to enhance the degree of confidence. These are assurance engagement. Compilation engagement, as we discussed there, is one of the examples of the non-assurance engagement. Do you remember that? A non-assurance engagement, we said, is where the practitioner does not express an opinion to enhance the degree of confidence. One example is a compilation engagement. So what is a compilation engagement? Compilation engagements are non-assurance engagements where the practitioner assists management in the preparation and presentation of the financial information without providing any assurance on that information. The practitioner takes information provided by the client, then compiles it into a financial statement format in accordance with international financial reporting standards. So he just compiles the information. In other words, he does the work which the accountant should do on behalf of the client, but he does not express any opinion on that information. It is a non-assurance engagement. That is straightforward, is it not? The practitioner does not express an opinion or conclusion on the reliability of the information because it is the management remains solely responsible for the accuracy and completeness of the compiled information. The management remains responsible because legally it is the responsibility of the management to maintain proper records. And compilation engagements are mainly used for internal purposes. They are used for internal management purposes or for specific external users who do not require assurance. There are users who may not require assurance. They may not just want to know the state of affairs. For example, a small business owner might engage an accountant to compile their financial statements for tax purposes or to present to a bank for a small loan where a full audit or review is not required. That's it for compilation engagements. Moving to the next concept is assurance reports. Assurance reports, number 11. What are assurance reports? Assurance reports. Now, assurance reports are the written outputs of assurance engagements. They contain the practitioner's conclusion designed to enhance the degree of confidence of the intended users about the outcome of the evaluation or measurement of a subject matter against criteria. Subject matter against criteria. So the end product of an audit, for example, is the assurance report. At the end of the audit engagement, at the end of the systematic and independent examination of an entity's operation, systems, information, records, and processes, the auditor has to write a report. That report is called assurance report. Assurance reports are formal written communications issued by independent practitioners, such as an auditor or other professional accountant, that provides a conclusion designed to enhance the degree of confidence of intended users. And in simpler terms, candidates, an assurance report tells users that an independent expert has looked at certain information like the financial statements or sustainability data and believes it is reliable and accurate based on a set of agreed upon standards. That's the meaning of assurance reports. Then we have direct reporting, number 12. Now, direct reporting, we've already discussed it here. Direct reporting, we discussed it here. I suspect that this is a typing error in the syllabus. This is a repetition. Direct reporting engagement is the same as direct reporting, which you have extensively discussed. So we skip that and move to the 13th basic concept in auditing, which is authorities and criteria. Authorities and criteria. These are two things, authorities and criteria. So we define first of all authorities. What is the meaning of authorities in auditing? Now, in auditing, authorities refer to the established bodies. Authorities may also refer to standards and regulations that govern how audit or assurance engagements should be conducted and how financial information should be prepared. So authorities could be auditing standards. Auditing, they comprise of the auditing standards, like the International Standards on Auditing, issued by the International Auditing and Assurance Standards Board. These are global authorities for conducting audits. In Kenya, we have the Institute of Certified Public Accountants that adopts and enforces these standards. Authorities also could be regulatory bodies. Authorities also are regulatory bodies. Bodies like the Capital Markets Authority in Kenya, or the central banks, which might also set specific requirements for entities under their purview. Authorities are also laws and regulations. Laws and regulations, like company law, tax laws, and other relevant legislation also constitute authorities that auditors must consider. So that's the meaning of authorities in auditing. Then criteria. What is criteria? Criteria are the benchmarks used to evaluate or measure the subject matter in an assurance engagement. For example, in financial auditing, the criteria is the International Financial Reporting Framework. If it is a compliance audit, then the criteria is the laws, the standards, the contractual arrangements, regulations, and so on. That is the criteria. The auditor examines if the company is obeying the laws. If it's a governance audit, then the criteria is a corporate governance code of conduct and so on. So a criteria are the benchmarks that we use to evaluate and measure the subject matter. I've given an example of financial statements in the subject matter, which is evaluated against a criteria known as the International Financial Reporting Standards. So that's the meaning of criteria in auditing. For financial statements candidates, we have International Financial Reporting Standards or Generally Accepted Accounting Principles, which are the common criteria. For internal controls, the COSO, which is the Committee of Sponsoring Organizations of the Tradeway Commission framework, is a widely recognized criteria for evaluating the internal control systems. If you are to evaluate an internal control system, then the criteria could be COSO. For sustainability reports, you may have various sustainability reporting frameworks like the Global Reporting Initiative, which can serve as a criteria. For compliance engagements, you may have relevant laws, regulations, and internal policies, which could be the criteria. So that's the meaning of authorities and criteria. Now, the 14th basic concept is assertions. 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 What are assertions? What are assertions? Now, in the context of financial statements audit, assertions are representations by management, explicit or otherwise, that are embodied in the financial statements. Assertions, in other words, are claims made by management regarding the recognition, the measurement, and presentation, and also disclosure of financial statements elements. Financial statements like the income statement, candidates, the income statement has elements. You'll have elements like sales, like purchases, then you have cost of sales, you have expenses, and other incomes. So the management makes assertions in these statements. The balance sheet will have elements like the fixed assets, current liabilities, long-term liabilities, as part of the elements in the financial statements. And these statements have figures. You may have sales 100 million, purchases 20 million. So these are assertions. The management is claiming that within this financial period, we made sales amounting to 100 million. That is an assertion. That is a claim by management regarding the recognition and measurement of sales. And auditors use these assertions as the basis for designing and performing audit procedures to gather evidence that the financial statements are free from material misstatements. Do you understand? Yes, that's the meaning of assertions. To assert is to claim. So that is assertion, basic concept number 14. Now we move to the next basic concept, which is internal audit. Internal audit number 15. Internal audit number 15. We are moving swiftly. Internal audit number 15 is internal audit is an independent, objective, assurance, and consulting activity designed to add value and improve an organization's operations. It is an audit function within an organization. It is internal. It is a function within an organization. We call it independent because as much as it is within, the internal audit, the internal auditor reports to the management or the audit committee, which is a committee of the board. This internal audit function helps an organization accomplish its objectives by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, control, and governance processes. And internal auditors typically report to the audit committee or board of directors to maintain their independence from operational management. So an internal audit function carries out evaluation of the internal control system. It also carries out risk management processes and also advises on corporate governance issues within the organization. The primary purpose is to serve the needs of an organization's management and the board. These are experts who help the board in making decisions, in providing information. They also help management in matters to do with risk management, internal controls, and so on. So they focus on improving internal controls, efficiency, risk management, and compliance with internal policies and external regulations. It is an independent function because while internal to the organization, effective internal audit functions maintain organizational independence, usually by reporting functionally to the board, but administratively to the management. So that's the meaning of internal audit. Then we have the 16th basic concept, which is statutory audit. Statutory. Statutory is derived from the word statute, which is a legally required independent examination of an entity's financial statements to ensure that they present a true and fair view of the entity's financial position and performance in accordance with an applicable financial reporting framework. Statutory audit is an audit where the law states that the audit be performed. We have, for example, the company law, which mandates public companies to conduct statutory audits. The purpose is to provide an independent opinion on whether the financial statements are prepared in all material respects in accordance with relevant financial reporting framework. And this must be conducted by an external independent auditor who must be a certified public accountant who is not part of the entities that is being audited. And the primary scope is focused on the financial statements and related internal controls relevant to the financial reporting. You understand? It's a mandatory audit. It is mandatory by law for certain types of entities like the public companies, large private companies, and specific regulated entities. The audit report is typically addressed to the shareholders or owners and is made public. That's the meaning of statutory audit. Then we have legal audits. 17. Legal. What are legal audits? Now, the term legal audit can have few interpretations, but generally it refers to a systematic review or examination of organizations' compliance with laws, regulations, and legal obligations. It is broader than a statutory audit because a statutory audit only focuses on the audit of financial statements. It focuses, a legal audit focuses specifically on legal compliance. The purpose is to identify legal risks, ensure compliance with applicable laws and regulations and contracts, and also assess the effectiveness of an organization's legal and compliance framework. It can be conducted by internal legal department, it can be conducted by external legal firms, or specialized compliance auditors, and the degree of independence varies based on who performs it. It covers all aspects of an organization's operations that are subject to legal requirements, including environmental laws, labor laws, consumer protection laws, intellectual property laws, corporate governance regulations, industry-specific regulations, contractual obligations, and so on. And these legal audits are often undertaken voluntarily as part of good corporate governance or risk management, though some sectors may have regulatory requirements for specific types of legal compliance reviews, like the companies that are listed on the stock exchanges. Most of them, like the Nairobi Stock Exchange, companies are required to conduct compliance audits or legal audits. Then lastly, candidates, we have governance audit as the last concept. Governance. What are governance audits? Now, a governance audit may also be referred to as a corporate governance audit. Is an independent assessment of an organization's corporate governance framework. Is the assessment of an organization's corporate governance framework. Governance. Number 1, corporate governance framework. Number 2, practices. And adherence. Principles. All right? Principles, adherence to principles of good governance. So a governance audit is conducted by a governance auditor, because candidates, there is a way in which companies are required to be managed and controlled. There is a certain way in which companies are expected to be governed or controlled or managed so that the objectives of the company are met. That's why we have corporate governance principles. Companies are required to adhere to corporate governance principles and also best practices in corporate governance. So a governance auditor comes in to evaluate whether a company is complying with the corporate governance framework. These are laws or regulations or principles of good corporate governance. The audit here, the governance audit evaluates how an organization is directed, controlled, and held accountable, focusing on the effectiveness of its board, the effectiveness of the board committees, focusing on ethical conduct, stakeholder relations, accountability and transparency, and so on. So that's the meaning of governance audit. It is a systematic, independent, objective examination of an entity's corporate governance framework against a criteria which could be the corporate governance framework or practices or best practices. And in Kenya candidates, good corporate governance principles are encouraged by bodies like the Capital Markets Authority and the Institute of Certified Public Accountants, and compliance is often a factor for investors and listed companies. If the company is not complying with these corporate governance issues, then it may not be listed on the securities exchange and so on. So that is the end of our first lesson in governance and compliance audit. In this lesson, we did an adumbration of the course outline. Then we have completed the first chapter, which is basically the concepts in auditing and elements in auditing. Concepts and elements in auditing. We have number 1, defined auditing. That's the first basic concept. Number 2, we've defined assessment. 3, monitoring. 4, assurance engagement. We've defined what an assurance engagement is. We've also outlined the elements in an assurance engagement. Number 5 is the non-assurance engagement. Number 6 is reasonable assurance. 7, we've defined limited assurance. Number 8, we took time to explain direct reporting engagement. Number 9, attestation engagement. Number 10, compilation engagements. We've defined assurance reports. Number 12 is a repetition of number 8, so we skipped it. Number 13 is authorities and criteria defined. 14, we've defined assertions. Number 15, internal audits. 16, statutory audits. 17, legal audits. And lastly, governance audits. And that's the end of our today's lesson, the end of the first chapter in governance and compliance audit. In our next session, we are going to begin on the second topic, which is governance and compliance risks. Thank you for attending the lesson. Take time, go through the lesson again. If you have any questions, please, below this video, there is a comment section where you can post your questions and we will address all your questions. Thank you. God bless you. Bye-bye.